Hi traders, welcome to the crude oil trading environment series. This will be a three-part series starting with video one, which is going to cover inside/range days. So the purpose of this series is to talk about different types of days, and a big part of the trading journey, besides just having your setup and how you're going to execute your trades, is to understand the context of the day, because not all setups work in all types of environments. So, like I said, video one is going to be covering inside/range days. Video two will be outside/trend days. And then video three will include something about transitional days, changing from one to the other, and vice versa. So let's begin. First, just to cover the risk disclosures, trading futures carries a high level of risk. Thus, it may not be appropriate for all investors. The investment value can both increase and decrease, and the investors may lose all of their invested capital. Under no circumstances shall the company have any liability to any person or entity for any loss or damage in whole or part caused by, resulting from, or relating to any transactions related to futures. Basically, this is for educational purposes only. I am not a financial advisor. Trade at your own risk. So the agenda for today includes first defining what is an inside day, and I'll show some chart examples. Then I'm going to talk about how I come up with my areas of interest on an inside day. Now, this is not a strategy in itself. I take a lot of other things into account. I use multiple time frame analysis, so that's a huge part that I'm not going through in this series. So never take one of these ideas and you can create an entire strategy based off of it, but make sure you use your own back testing and come up with your own ways of implementing it. The other two things I will talk about are high probability price action destinations. So where will price likely go that day? Nothing is guaranteed in trading. We trade in probabilities, but you will notice that on certain types of days, price tends in a high probability context to reach for certain areas. So we're going to look into that. And then the last thing is more of an intermediate level, is how to look at inside days, which look like ranges, how to trade those and determine if there's really a stronger bias one way or the other. So within a range, you can go up and down, but there might be some indication in price action that will tell you that going down will be the more impulsive move, or going up might be the more impulsive move, and that might be the way you focus on for that inside day. It's going to make more sense when we go through some chart examples. So let's start with the definition. So the definition of an inside day is when current price action is trading within the previous day's range. When I say the previous day's range, I mean you mark off the highest price, you mark off the lowest price that crude oil has traded, and that's the range, all in between there. So if we are in the middle of that, or anywhere, even not near the top, but we're still inside of it, that counts as an inside day to me. When do I assess this? I come to the chart at 7:45 in the morning, well, a little bit earlier to do some other things, but 7:45 is the time that I will assess, are we inside or outside the previous day range? Now, why did I choose that time? I chose that time because this is going to be a few minutes ahead of when many New York Eastern traders are going to enter the market. A lot of them come in at 8 a.m. So, excuse me, they are assessing them. That could be the start of a move starting at 8 a.m. So I like to come in a few minutes before that to determine where are we compared to the previous day. And I also compare us to London and overnight price action. But that's another step that we'll talk about when I show you chart examples. But let's just focus on the inside-outside day definition. Now, you can start inside at 7:45, and then maybe at 9, maybe at 9:30, maybe at 10 a.m., you can come out of the previous day range and turn into a trending type of day. So this doesn't mean we stay inside for the rest of the day. This is a one time that I'm assessing it, and then situations, of course, can change in trading. And you need to have a method for determining when that situation has changed. So for my trading purposes, The way that I trade crude oil, I use 3 different time frames. 2 of them are not really time frames, they're tick charts, but I use a 60-minute, this is for intraday trading, 60-minute chart as my trend, kind of like my higher time frame zones. I use daily too for big picture zones. My intermediate chart would be the 3800 tick chart, and then my execution chart is the 350 tick chart. I used to use the 1000 tick chart, but with the volatility after Russia and the Ukrainian crisis, I had to tone back risk, and I was able to do that by dropping down to a smaller tick chart, 350 ticks. So now with any time frame, you can see the previous day high and low. You can use 5-minute charts. You can use a full daily bar chart if you want. Anything above that, you're like, if you use weekly, obviously, or monthly, you're not going to see the previous day because there's multiple days within one of those bars. So from daily lower, you can see the previous day and easily mark the high and the low. Now, here's a picture of daily candles. I wanted to note that you'll see that many times for most of these days, price action on one day will overlap the previous day. So what do I mean by that? Here's one candle right here that I'm highlighting in blue. You'll notice that the candle after it was trading within the range. Now it did pop out on top. So that happens very often. You'll notice that price action will tend to trade within the range and then break one of the sides. This is very common. So let's look at a couple more examples. Let me just erase that. I'm going to change the color if I can here to something a little bit more visual. Let's use yellow. You can see, let's look at another one. Here was the previous day bar, let's call it. We'll pretend this is the current day. It was inside the range and it popped out the bottom. And it's a wick, so that means it came back. So it popped through, came back. Look at the next day. We also popped out. This one is an interesting day. Very volatile. Look at how large this candle is compared to the rest of all this price action. But you popped out the top and you broke through the bottom. So that is an outside day bar. But you'll see that doesn't happen that often. We mostly see price action pop out of one side, like I said. But just do your own back testing and note how price in the current day reacts with the previous day bar. And you'll see some patterns there. So let's go ahead and look at some examples of inside days in more detail. Like I said, these are daily bars, so we can get a big picture here. So let me erase this. And let's go ahead and look at some examples of inside day bars, inside day ranges. So we have 2 different days here. On the left side, we have the previous day session marked by these perforations, the beginning of the session. Now, the start of this counts from, I believe it's 6 p.m. on a given evening, and it goes through the next 5:15 p.m., I believe. So this is a 23 and a half hour period, let's say. And we're going to count that as the previous day session. That's what these lines are here for. Now, this is the current day session in red over here. Now, obviously the day is complete because I took this picture, after the fact, which, that's how I had to pick examples. So we're going to pretend that we are at this point here and none of this has happened yet. This is how we are assessing if it's an inside or an outside day. So what are we doing? We're coming to the charts and we are at about 7:45 a.m. and we are looking as to where price action is in comparison to the previous day high and low. Now you're going to mark off the previous day high with a nice horizontal line and extend it through. Again, you mark the previous day low and you also extend that horizontal line all the way through to today, through the entire trading session. Now my trading session personally is from about 8 to 11:30 a.m. I tend to be done closer to 10:30 a.m. Eastern time. I don't trade the afternoons in oil. Some people do. I don't trade during the lunch period. I like to be done before the lunchtime session hours. during Eastern time. So that's just my preference, and that's where most of my kind of setups show up. So back to this, 7:45 a.m. This is a tick chart, so it's not a time chart, but 7:45 a.m. happens somewhere around here. You can know that we can see that the previous day high is up here. So we are in between the high and the low. We are inside day. So you'll notice, and as we look through examples, how does price react around the previous day high and low? These end up being very important key tested levels. So we'll see examples of that in a minute, but you can even see here that we got stuck there, we got stuck here, and then it collapsed and ended up making it back to the other side. So we had if you looked on a higher time frame, you would notice that this looks like a poke. It would look like a wick through the previous day. When we came back in, it would basically be a wick and then the body coming down. My drawing is pretty poor. Okay, so let's look at a couple more examples so we can get used to seeing this. And how do we mark this day to day? Here's another example. Current day is on the right side. Previous day is on the left side, in between the perforated lines. So we mark the previous day low down here, extend that horizontal line, previous day high up here, extend the horizontal line. 7:45 a.m., we are floating in between them. So it's an inside day. Why do I care? Because I know that previous day low and previous day high will be key areas for me, either to reach as destinations or to poke through. That's how I think about inside/range days. Calling them range because if you think about the daily candle, this is the previous day, let's pretend, and we're trading in here. This is moving in between what I'm calling a range, the range of the previous day high and low, which I should actually have the wicks marked like that. That's the high and the low. But we're trading inside of this range. Even if we poke out and come back in, we're still inside of the range. So we're treating it almost like boundaries. You never know. We can break out and keep going and have a strong turn into an outside day is what I would call that. Turn into a trend day. And there's ways to see when that situation might be changing. But at the beginning, I'm assuming that we're going to stay inside the range. There's other things I'll take into account, such as, have we had multiple inside days in the past couple of days? Is this the third inside day? Because the more days you have in a row that are basically consolidated, if you think about inside days, it's a consolidation, isn't it? Now, the more days in a row you have like this, the higher chance that it's going to get ready to break out and continue the trend or reverse. There's two things that can happen. So it can be a downtrend like that. You have the inside days that you're trading, and then it continues on. Or you can have the downtrend. You have the consolidation. These are my candles. You're at a key level. And then we reverse. So all of these things can happen after the inside day consolidation period. But this is tradable to me. Some people don't like to trade what they're calling ranges or tight, quote unquote, tight consolidations. To me, oil for intraday trading is not tight. Yes, it's tight compared to an impulsive move. But on a range day, on an inside day, you can have a move even of, let's say a $2 range in oil. And let's say ATR is between $4 to $5. So we're saying that it's moving half of the amount that it usually does on an average basis. $2 times $10, we're times, we have $2, sorry. So this is the same as saying 200 ticks. Times that by $10 a tick for a full contract, we're saying a $2,000 move for the day. Now, we're not saying you're going to catch stuff from high to low. What I'm saying is that even if you got a small percent of that, you can make something for your day, intraday income. So that's why I enjoy these days. Okay, so that's just a little bit of fast math there for us. A lot of information I'm throwing at you, but going back to the inside day visual of how we're acting at the previous day high and the previous day low. As you can see at 7:45, we didn't make it all the way down to the previous day low. We were in the lower part, like if I broke this up into segments, let's put a midpoint there. We were in the lower half of it. Now, some people might say, when you're in the lower half of it, you're in a discount area. Why is it a discount area? Because you had buyers that might have started here and pushed price up. Now, they may be looking to re-enter and get more put more buy positions on when you retrace to these lower prices again, which is, if people out there enjoy using Fibonacci retracements, which I do, you might notice that this might be a 78.6% retracement, or it might be a 61.8% retracement. Some people use that as areas of interest in a given leg when price retraces, and then they'll take the next leg up. That's a different conversation, and it is one of my inside day strategies. But like I said, this is not really a strategy tutorial. It's more paying attention to how we look when we start the morning, and where might we go to, where might we breach. So in this case, we started to climb. Remember, many inside days will poke through one of the sides. Now this one didn't make it down here. So the morning New York session started to climb. That tells me that there may be a high probability, in addition to the fact that we had an up move yesterday, that we may break the highs. I'm not saying break and keep going. What I'm saying is poke through. Why? You have a lot of stops up here. You have a lot of stops, and the stop orders will provide liquidity for people who want to sell at these higher prices up here. So, and that's exactly what happened. If you notice, yes, it was 1, 2, 3, 4, 5. Let's say 5. It took 5 candles to turn back around, but on a higher time frame, this looks like a poke through. If you looked at a 60-minute or something like that, it will have a wick. This is a tick chart, so like a 350 tick chart, or this might be a 3800 tick chart. So you'll see more candle action, but consolidated together on a higher time frame, it looks like a wick. So as you get used to fractal patterns, you'll be able to almost see this group of candles and envision what it looks like as a consolidated candle. That takes some practice, but you will get there. So let me erase all of these drawings. Let's look at what an inside day is not, since we just showed 2 inside days. Okay, here's the previous day. Here's the current day. Current day is 7:45. Remember, none of this other action happened yet in our heads as we back test. Here's the previous day high. Here's the previous day low. At 7:45, we're not in between it. We're outside. We're above it. So is that a bullish signal? It might be. It might be. So we still pay attention, because this is a very important breached area. It's a very key area that many people use. So I still extend that line, and I like to see what happens when price returns there. Are you going to use it like a floor? Are you going to get back in, hold it, and then drop? Then this ends up turning into kind of a poke through situation. These are all questions you want to ask yourself. But my initial thought, whenever I have an outside day, because that's what this is, and we'll go through it more in the second video series, which I'll release soon, is I'm no longer thinking about this as inside day strategies. I'm thinking that I'm going to see if this will use it as a, since it broke it, if it will hold it as a floor. Then I'm thinking that this may have legs to the upside. So this is all what I'm observing each morning. Or some people don't even want to trade these kind of days. They're like, oh, you know what? I like to trade the bounces in between. I don't want to trade these, what could turn into a trend day. So that's something to think about for as you develop your strategy and your style of trading. Okay. Now, there's a couple of questions we need to ask ourselves, and it's going to really help you determine that context in the morning. So people say, what's the trend? How do I determine if we're going to reverse here? Where could it go? This is what we call context questions. And there's price action evidence, let's call it, that you can read that will give you sort of an idea of what environment you're working with, right? So, for example, if you come to the chart at 7:45 a.m. Eastern, Asia and London have already, Asian session has passed, that's the beginning one. Then we have London right before us. Now, London can have some good moves. So London can set a trend. London can be the reversal time. So there's many things that can happen during the London hours. So I look at that price action and I say, how did it look? So for example, if we're looking at London, hold on, let me just make sure I can draw this right. If we have a previous day like this, not like that, but let's say we're generally moving up, that's the previous day. Then Asia happens. Then London happens. And London, this is all of London, let's call it. Look at the way London looked compared to the previous impulsive move. That's tight. That's a tight range. So that tells me I need to be prepared that oil might be coiling up to make a strong move. Why? Because you only stay so tight like this so long before usually a strong move. Yes, it can do poke through, and then the strong move. A lot of people get chopped up when it's too tight. So that's something to pay attention to. Okay, another scenario is you come to the chart and you see Asia and you see London, and we're here. This is 7:45 right here. What do I notice? Of course, you got to take previous day range into account. Of course, I'm going to look at my higher time frames and say, where are we compared to the previous week high and low, previous week open and close? These are all key levels that I pay attention to. But I do notice, and I'm going to note, that London had one strong leg down. Now, for those who study price action, some people believe in Elliott waves. Some people study, different kind of impulsive versus retracements, the measurements of that, Fibonacci, all this stuff. From my studies, many times moves will happen in at least two legs. So if that's leg number one for me, and we pulled back like this, and this is becoming the start of the New York players coming in, I'm almost going to anticipate that there may be one more push lower, because you had a lot of sellers in here, and the retracement is happening around the time that New York hours are coming in. Can it go like this and keep going? Of course, it always can. But what I'm saying is you want to read the context of London's message, let's call it, and how we might interact with that. So that's one more stage to inside days that we want to take into account. And I will show a picture of what I'm trying to say here, because I know my drawings look crazy. So looking at this here, just want to make sure we're covering everything. Did it hit any weekly key areas overnight? Here's another thing. Pretend this is price action, previous day. I don't know why I'm obsessed with uptrends. And you have this. This is the next day. So this is Asia and London. That's how we're starting out the day session. And overnight, you notice, so this is all the way up until 7:45. You notice that you poked through the previous day high. And your question to yourself is going to say, so did we poke through the previous day range? This is important. Where did it poke through and what did it hit? So if this area here happened to be previous week high, let's say, previous week high, and you get a drop like that, while we're inside the previous day range, I know I said to pay attention to previous day low, previous day high, and I often just trade at those areas. I may be okay trading inside of here down. Why? Because we may have a bearish bias given that we're coming off of a very strong higher time frame area. And it had such a good reaction to it that I may be looking for the retracement to do the second leg down and maybe break that previous day low or get to the bottom part of yesterday's range. So this is all things that we're taking into account. And this is a little bit more advanced. And this is also what I will cover in transitional days. So I don't want to get into too many details about that. But I'm just letting you know that you don't just look at price action and say, are we trading inside the previous day range? Okay, I'm going to take the pokes at the highs and the pokes to the lows. You can look at that. But if you want to add one more layer to your tool to your arsenal, you want to take into account, you want to be able to read price action, context and clues from previous sessions and previous days. One more thing to take into account. Make sure we might be ranging ahead of the 10:30 crude oil report that happens on Wednesdays. Sometimes it happens on Thursdays if Monday's a holiday. So pay attention to this. So, or if there's other, non-farm payroll, some other high red impact news, we might be ranging ahead of that news. So this is also a message that we could be waiting for something. It's waiting for the news release before it's going to choose its direction. This also can happen ahead of OPEC news, where it can get totally wild as soon as the news starts, as soon as the meetings start. So I don't even trade those days because I can't even figure out, I can't handle that sort of volatility personally. Okay, so I threw a lot of information out at you. Let's talk about, well, we kind of spoke about this, but let me show you what a picture of what I mean when I have this little saying, inside day ends in play. What I'm saying is that I don't like the middle of the range on an inside day. So what do I mean by that? 7:45. I'm taking an estimate that 7:45 is around here. Now, let me just change this color a little bit. Maybe just to black. Now, we have the inside day and we come to the chart. So 7:45. Now, sometimes 7:45 is right at the edge of the previous day low. I'm still going to count that as an inside day until I see a strong move away. Then I may start to consider that, maybe we're breaking out. Let's see if we retest, and let's see if we're going to just have an outside day. So you got to read the context. But we're right on top of it. So there's still chance that this is going to be a failing situation. Now, I have added an indicator here. You don't need to use an indicator, but I really enjoy the MACD on my execution time frame. And during the MACD is a whole other lesson, how to use it. I don't just take overbought, oversold, because you need the right conditions to be able to use that. And if you're in a trending environment, you look at this impulsive move here, for example. Overbought. You're going to get chopped to shreds if you're trying to sell this thing. You got to read the context of price action. Now, I look at that when I do enjoy the overbought, oversold when we're in a range type situation. So here's 7:45 a.m. We're at the previous day low. We're starting to show wicks. We are over sold and curving. So right here, we're starting to curve. The MAs are starting to flip over. This starts to become a bullish signal to me when we re-enter the previous day range. Where am I looking to take this thing? Remember, we talked about what are some high probability destinations or targets. Now, you broke the previous day low. Can we make it to the previous day high? Yes, that can be a destination. But if you're trading multiple contracts, which I do, you need to take into account the overnight range. So first destination would be poking our own overnight high. So I treat this as almost like a baby inside day. I know it's kind of confusing. But basically, you mark the overnight high and the overnight low. Overnight meaning before 7:45 a.m. In my personal opinion, that's how I trade crude oil. You'll notice that we poke through our overnight high. Remember, inside day ends in play. What ends? Overnight ends. Previous day ends. These are my 4 areas I'm looking at to potentially be rejection areas. And what happened? And time of day. So look, we're getting over here. This one happened at about 8 o'clock when New York players started to come in. Had a strong move, broke the other side. started to flip over again, over bought in this case. Nice 9 a.m. time frame. Made it. Now you've, check this out. There's so many things to take into account when you're reading price action. You already broke these lows. What do you think might happen? It was already tested. Yes, it could have went like this and then went up, of course. But you also had a probability, if you went to a higher time frame, to try to find a better area that might have buyers, since the buyers here might be done. So this area, there's a chance that it's going to be poked, which it did right here. And even went even lower to find better buyers over here. So what I'm saying is that when you had this rejection here at this end, I'm not paying attention to the overnight low, which is here, because we've already traded after that has happened, we already traded under it. So price action will tend to move like this. You know, to poke through, find better buyers and sellers. You'll start to notice this. You have to study price action and you'll start to see all these little things that you can take into account. Now, this is also part of the transitional video that I'll do. I'll just touch on it very briefly here. This was an inside day for the morning. All of this. We became outside right here. What I would be looking for is, how do we act when we retest previous day low? Because that's what broke. We broke strong out of it. Let's pretend that's strong. We don't know if this is a weekly level. This could be something else. We have to pay attention to higher time frames. We come back. We come a little bit back inside. Okay, that's not like the cleanest rejection, meaning like touch it from here and drop. So I would just watch it. This is still, we don't know what's happening here. Now, because you had a strong up move, we need to see what happens. Now, when you get back inside again, for the second time after breaking out, this starts to become a red flag that we may be coming back inside the range altogether. And we start to watch the reactions. And if we hold inside, you can start to see these wicks. And you could even see a strong bull candle right there. Back inside the range. Now, there's a lot of other things we could take into account. But the fact that you did all of this, you came out, tried to retest, came a little bit too far in, and then stayed in here, this can tell you that we may have a strong move back up. We've already touched and poked our previous day high. Done. The next level would be up here, the higher range of the previous day range. So when I say range, like I said, I like to use Fibonacci's. You don't need to. You can still pay attention to the general previous day high and low number, which is just one number. But I do break this up into segments in a way. So we're at this high range right here. This is the end of the day anyway, so many people will just exit their position, let's say around 3 p.m. Eastern time. Okay, so that was a lot of information. Now, let me show you. Let me just change the slide here. Here's another inside day ends in play. Got seven. I don't have the time on here, but 7:45 was sometime inside. Previous day low, previous day high. We marked it out. Now we're paying attention to. Here's the overnight low, overnight high. Remember I said overnight ends I'm paying attention to. Previous day ends I'm paying attention to, and see what we do there. Now we broke the previous day low, came in. It didn't make it all the way to at least over here, but it did it again. For those who enjoy divergences, which is another technique of mine, you'll notice there was a MACD divergence on the histogram. Poke through, you can see that you have a lower low here, but the histogram is climbing, and immediately came back inside the range with an impulsive candle and a retest. So you got to study your own price action to say, what does a reversal look like to you? What does a rejection look like to you? Is it a candle with a long wick like that? Is it a broken high? And now you count it as you're good to go in the long direction. So you need to have your own definitions of what gives you permission to go long in this context, because you are coming down. So what tells you that this has changed? You have to have your way of doing that. Now, we have overnight high that can be, so we broke overnight low, we broke previous day low, and immediately came back in. We may make it to the other side now. So we have that. And, you got to use your own price action methods. Yes, I'm going to look at previous day high, but this range is pretty large, and you'll start to get used to. Remember, I said you can break up the previous day high and low when it's a super large candle, especially because that's a big day range. You want to see where 50% of it is, and you want to mark that. Let me show you why. So let's say 50%, I'm eyeballing this, is here. That's half of the previous day range. This area might be considered a premium, meaning sellers may be starting to jump in up here if you have a zone. Buyers, these are discount prices. Let me not call it buyers. Let me call it discount. So discount. So price likes to go from discount to premium and back. So buyers jumped in the discount area and took it up. Here's where we start to pay attention that we're in the premium zone. So you want to look for areas, key areas of, let's say, rejection. So this wicket, this is like screaming at me, as where we might get rejection again. But you got to use your own way of determining, when do you get out, and targeting and entry specifics. That's not part of this session. This is just showing you high probability destinations, but not exactly what's telling you when to get out, what kind of candle pattern, what should the MACD be doing. That's not this kind of lesson. So you need to do your own specific execution studies in order to figure that out. Okay, again with the high probability destinations. Right here, we have 745 area over here somewhere. Maybe it was over here, try to remember. Now, remember, inside day ends in play. Paying attention to the overnight high and low. Pay attention to previous day high and low. Started to climb. There's no sign to me of a rejection here. Totally broke right through. Next destination. Look at that nice poke above the previous day high. MACD lines overextended and turning. There we go. Now, destination, overnight low. Expecting it to be poked. Made it there, and that was so close to the previous day low that you have destination 1, destination 2. These make sense as to where price may want to go. Now we start to pay attention and watch this area. Why? Because the previous day low, two things can happen. We can poke it and come back inside, or we can break it, touch it, and turn into a trending day. Continue the trend down, let's call it. So there's two things that could happen. So observing price action around this level and not just jumping in all over, make sure you have a setup that makes sense. But say you took this long here. Okay, you got stopped out. We broke under now. And when we came back, it seems to be holding. There's a stronger move down. Watch how it comes back. Now you're getting all sorts of wicks here. This is giving you a red flag. This shouldn't happen if it's going to do a poking in. It should be a little bit more aggressive. This is not looking good. This is looking like it's holding as kind of a ceiling. And we may consider that we're going to get a leg down. Of course, taking into account higher time frame trend and bias and levels. There's a lot to take into account here. Okay. So here's the last picture I'll show you. Now there are inside days, like I said, where we're just trading back and forth. We're breaking the top, we're breaking the bottom, breaking the overnight low, high and low. And we're just swinging side to side. And that's the kind of day it is. Now, there can be a bias, as I said. And I drew it out with the London picture, if you remember. When London has a move, sometimes we either continue that, or sometimes London is the retracement. to continue a trend that has already been in place. And New York jumps in and continues the trend. So we have to take all of this into account. Like what session are we in and what happened? So let's look at this. I pulled in a couple of days of price action here. Why? Because I don't just trade with 2 days, like current day and previous day, and just have those are my 2 pictures. Can you scalp that? Yeah, of course. But I like to have a little bit more of the picture in place, at least a couple of days of price action. I drew the green arrows to show you that we are clearly in an uptrend. Higher lows, higher highs, impulsive, strong moves up, shallow retracements. This is an uptrend. But then we hit this day. This day is inside. It's an inside day, isn't it? It's an inside day because that's the previous day high and the previous day low is all the way down here. So what's different about this kind of day? I'm going to mark the overnight low and high, which I did right here. You can see the pictures. So still the ends in play. So that's area 1 and 2. Overnight high is also very close to the previous day high, so I would just use that kind of like a zone. And we obviously have the previous day low all the way down here, right? We don't know if it's going to get back down there. It might, but that's a very big, you can see that this is a very big range day. So we're watching and we see an immediate poke through the previous day low. The overnight low. So it's going to depend if this is after 7:45, which it is. I again forgot I chopped off the times. I don't know why I did that. So if you notice, you can have a little bit more of a looking for buys mentality. I know we came down strong like that during London hours. So part of us might think, oh, this is turning around. This is turning around. I'm going to look to get short. Now, like I said before, things happen in twos. So there's leg number 1 and that's leg number 2. So you could have sold this, but I'm looking more for the impulsive move to be to the upside, because until I see reversal signals from a higher time frame perspective, we're still going with the trend. We're looking for those moves to be the best, the furthest and the strongest. So when I have that break through the overnight low, I may want to hold this trade a little longer because of being with the higher time frame trend and this just being a potential retracement. So you have the mama and the papa on your side, maybe the 60-minute and the daily on your side, even the 60-minute, because for day trading, say you're in it in 2 hours, that's only 2 60-minute candles that you're in. So this looks like, it was probably, so if this is the end of the day, the move of the day was up with the trend. So you want to take all this. Yes, you could still target the overnight high because, like I said, destination is from end to end. Or, like I said, use this like a segment, and you could use Fibonacci to try to get 61.8, 78.6, or the full move. There's so many ways to do this. You can peel off targets along the way. Some people add on. There's all sorts of ways to engage here. So let's just recap a few things here. We have the context is that we show up at 7:45 a.m. and we're trading inside the previous day range. The opportunities that it may present is to play these false moves, these false breakouts that happen at the overnight high or low or the previous day high and low, with keeping in mind that the higher time frame will always be in charge, will always be our guidance as to where there's more odds on our side. So if we're climbing up and we see the false break through the high of the day and that there's a general downtrend, so this is kind of like a retracement up, we know that has a higher probability of working out to continue to go down now, because now you're joining in with a higher time frame trend. So you want to take a few pieces into account, but this is an easy way, not easy, but a simple way to just have some 4 key areas marked during range days. During the inside days, like I mentioned before, MACD, the overbought and oversold conditions are more reliable. Even the divergences that you can use are more reliable than in trending cases, because those conditions can stay like that all day and beyond. Give a lot of false divergence signals. You got to be careful trying to call reversals on those strong trend days. So always keep in mind that inside days can change because it's a consolidation period, and price consolidates for a time. It could be a couple of days. So look back at your instrument like this. Like I said, this is for crude oil specifically, but let's say crude oil trends, let's say 4 days in a row, 4 or 5 days in a row, and then usually gives an impulsive move after that. Every instrument is different. Some will range for days and days. Some 2 days it's too much consolidation, and then it's just like a super trendy instrument. So you have to learn your instrument and apply it. So we will talk about outside days and trending conditions, because I did show you an example of how to identify that, but I want to show a few more pictures and potentially what the areas of interest would be on those kind of days. And also, like I said, a few tips on using the MACD in those specific conditions. I hope this was helpful, and I'll see you in the next video.